Good morning. This is Lapriel Hernandez from Benefit Partners. Welcome to our Healthcare Reform webinar designed for the large employer. Today we have George Seacott from the Seacott Law Firm, which specializes in employee benefits. George just returned from Maui as the featured speaker for the Automobile Dealers Association. Welcome, George.
Okay, thanks, Lapriel. Yeah, this webinar format is not quite as good as giving a presentation at the Fairmont Hotel in Maui, but it's not always as good as that. So I don't know if being in Maui helps you learn better or not, but it certainly was a fun place to go give a presentation. In any event, we're going to talk about today health reform, talking about it primarily from the employer's perspective. So a roadmap as to what we're doing here today. We're going to talk through, try to keep it in as simple as possible, explain this employer mandate. You might have heard it called the play or pay mandate. Basically the obligation that large employers now have to provide health insurance to their employees or pay a tax. So we'll explain that, and we'll also spend, here in the Eastern Washington market, there's a lot of smaller businesses. Some are going to know that they're well under 50. Some are going to know they're easily over 50. But in my experience, we have a lot of folks around here who are maybe over 50, maybe under 50, depending on the time of the year and what's going on. So we're going to talk a little bit about how you can determine whether you are over 50 and have to comply with this rule. After we talk about the rules, we'll have some numerical examples that will hopefully help drive home the points that we've tried to explain. And then we'll cover a little bit of additional detail. And finally, we'll end up with a to-do list so that you, on behalf of your business, can through the rest of this year, get up to speed for this new tax and do what you can do to minimize your obligations under it. Two essential questions in determining whether or not this mandate applies to you. Step one, do you have 50 full-time equivalent employees? If not, you don't have to worry about it. But if you do, then you go to step two, should you play by providing health insurance or should you pay the tax? Step one to determining whether or not you've hit this 50 employee threshold is you've got to count all the employees of all businesses that are under common control. Now, common control, we could have a whole day seminar talking about that. But if you've got multiple businesses that are generally 80% owned by a single parent, or if you've got a group of 5 or fewer individuals who collectively own 80% or more of multiple businesses, those businesses will generally be under common control. So you aggregate all these businesses under common control. You add up all of their full-time employees. For this purpose, full-time means 30 hours a week, so about 3/4 of what we would normally think is full-time. And you determine the average number of full-time workers you have over the course of this year, 2013. So I'm taking you through here. This is step one, part one. If you'll follow the steps that we give you here, you will have conclusively gone through and determined whether or not you have anything to do for next year. So if you look at your average full-time employees, average by month, if you're under 50, we're going to go to part two. If you're over 50, there's a couple of other exceptions that we'll get to in a couple parts down the road. So part two, you're under 50, you're thinking, well, we don't have 50 full-time employees, what do we do next? After we've looked at our full-time employees, again, 30-hour full-time employees, we're going to look to our full-time equivalents. And this way you look at all your part-time workers under the health reform rules. They're called variable hour employees. You look at your part-time workers of all businesses under common control. You add up all of their hours each month, and then you divide those total hours by 120 to get the number of full-time equivalents each month. And now we're just going to do the same thing we did on the first part of this step. We're just going to add together our full-time employees plus our full-time equivalents and see, does that get us over the 50 threshold? All right? If, when we look at full-timers and full-time equivalents, we're still under 50, you guys can breathe easy. You don't have anything to worry about under this employer mandate. However, if you're over 50, then you likely are going to have to ultimately comply with the mandate, but there are still two exceptions we need to run through. And so the first one we'll go through is on part 4 on the next slide. The first exception, this one could delay your obligation to comply with the mandate from 2014 until 2015. So this one gives you a 1-year delay. And in this one, what we do is you look at your monthly average of full-time plus full-time equivalent employees over each of the 6-month periods this year. So the first 6-month period is January through June, February through July. You see them all listed there on the slide. If during any one of those 6-month period, your average total of full-time and full-time equivalents is under 50, then you are exempt from the mandate for 2014. You have a 1-year delay, and instead you have to worry about it the following year for 2015. However, if during all of these months your average is still over 50, then looking like you're going to need to comply for 2014. There is one more exception on the next slide relating to seasonal employees. If you don't have any seasonal workers, then obviously this exception is not useful for you. But if you do employ seasonal workers, and if you only use seasonal workers during 4 or fewer months, then you may be able to use this exception. If you use seasonal workers during 7 months of the year, even if they're different groups of seasonals, chances are this exception is not going to work for you. So let's say that you do use seasonal workers and you use them during 4 or fewer months, then we'll continue on to the next part of this step. If your monthly average full-time plus full-time equivalent count is under 50 for all the months except the months in which you use seasonal workers, then you can continue through this step. If not, if you have any months that you're over 50 that didn't involve seasonal workers, then this exception doesn't work for you. During the months that you employ seasonal workers, is the only reason that you go over 50 due to the seasonals? If the answer is no, if you hire some other full-time workers that bring you over 50, then this exception doesn't work to you. But if yes, so again, all the requirements to fit this seasonal employee exception. You use seasonal workers 4 months or fewer during the year. Your average is under 50 during all months except the months in which you use seasonal workers. And the only reason you go over 50 during those 4 or fewer months is because of the seasonal workers, then yes, your business fits this exception and you don't have to satisfy the mandate in 2014 or in any later year. So there is this narrow exception for seasonal workers. If they're the only reason you get pushed above the 50 threshold and otherwise your permanent workers are fewer than 50, you generally will not have to satisfy this employer mandate. It's pretty complex. I know we took it through a number of steps to get through this, but that's the way that seasonal exception works. All right. Now, other comments on seasonal workers. Other than the purpose of this seasonal exception determining whether you're in or out of this mandate, whether you've crossed that 50 threshold, you still have to count your seasonal workers to determine whether they're full-time employees that you may have to provide coverage to or pay the tax on. We'll talk about that as we get on to some further slides. So we've now completed the first portion of our presentation, helping you determine whether you have more than 50 or fewer than 50. And again, most people are going to know they're going to be well under or well over, but there's a number of folks right in that middle ground that are uncertain as to where they fall. Hopefully what we've provided up to you until now will help you figure out where you are in this analysis. Step 2, from this point forward, we've moved beyond. We know that you have more than 50 people. We know that you're subject to the employer mandate, and so now we're going to help you decide what are you going to do. Are you going to provide health insurance, or are you going to pay the tax? Now, we told you in step 1 when you're trying to determine whether you have 50 full-time employees or full-time employee equivalents that you've got to aggregate all of your businesses that are under common control. Now that we've crossed that 50 threshold, we can split our businesses out again. Each of the businesses, even if they're under 50, you've got 2 businesses each with 30 employees. Okay, that gets you 60. That gets you over the 50 threshold. Now both of those businesses are in the game, and now that we know they're in the game, we split them out again separately. And each of the businesses is going to have to determine whether or not they pay the tax or provide insurance. So here we go. We're going to go through the play portion first, what it takes to provide insurance to avoid the tax. First step in deciding whether you're going to offer coverage, if you're going to be able to offer coverage and avoid the tax, you have to make minimum essential coverage available to 95% of your full-time employees and their dependents. So, real simple explanation. I have a client out in the Midwest. It's a big manufacturing company. They've got 10,000 employees. They provide health insurance to 9,000 of them. They are considered a great company to work for with great benefits. Everybody out in that part of the country, or at least in the town where this company is based, wants to work for this company. It's the best company to work for. And they only provide benefits to 90% of their full-time employees, 9,000 out of 10. That's not 95%. Consequently, this employer is going to be on the hook for a $2,000 tax, not just for the 1,000 who they don't provide insurance to, but for all 10,000 of their employees. For those of you quick at math, 10,000 employees times $2,000 a person is $20 million. $20 million tax because they don't provide coverage to 95% of their full-time employees. They only provide it to 90%. Now, later on, we're going to present to you an example as to how that company can solve their problem, or at least significantly minimize their problem. So you'll need to be paying attention as we get on there. All right, another thing worth mentioning here, you've got to make the coverage available to your full-time employees and their dependents. Strangely enough, for this purpose, dependents means children only. It does not mean spouses. Okay? What's the reason for that? Far be it for me to even begin to wander into there. It seems suspicious to me. I'll say that and leave it at that. But I'm sure there's some motivation going on. I'm not sure exactly what it might be. Have some ideas, but I'm not certain. Now, why do we care about this concept that the rule requires employers to provide insurance to their employees and their employees' children, but not to their employees' spouses? Well, even though many employees now do provide coverage to spouses, you've got to know that as time goes on, the insurance policy offerings tend to evolve to match statutory requirements. And if now under the law, all that employers have to do to avoid the tax is provide insurance to their employees and their employees' kids, you can imagine that many policies out there are going to evolve to have just that coverage. In other words, I suspect that as time goes on, coverage for spouses is going to be more difficult to obtain. All right? What could that mean? Well, that could mean that if your employee has a non-working spouse, your employee and the kids get their coverage through work, and the non-working spouse is forced to go out onto an exchange and get an individual policy. That's suboptimal for many reasons, the least of which is under different policies, you've got different deductibles. Rather than being able to aggregate the deductibles for everybody in the family, mom has her own separate deductible and dad and the kids, or maybe it's the other way. Mom and the kids are under the work plan and dad is stuck on the other plan. Either way, you've got some issues there. Now, and I only have one client who does this, so I don't think this is very common, but I do have one client down in Texas that makes coverage available only to their employees, not to any dependents. Okay? If anybody on the line has that situation, know that you're okay for 2014, but during 2014, you have to take steps so that during 2015, your coverage will apply to your employees and to their dependent children. Okay? So step one in this offer of coverage, make sure you're covering 95% of your employees. If you don't, you expose yourself to the $2,000 per employee, per full-time employee. Oh, one other point mentioning here, we're only talking about real full-time employees here, 30 hours a week to the extent that you consider that a real full-time employee. But a full-time employee who works 30 hours a week is who we're talking about here. We don't care about full-time equivalents anymore. We only care about them to get us over that 50 employee threshold. The example I give on this point, we all know that Walmart, even if it was all part-time employees, they would be well over the 50 full-time equivalent threshold, right? Because they've got stores all over the place. They've got tons, thousands, probably tens of thousands of employees. But if Walmart limited all of their workers to 29 or fewer hours per week, then they would not be subject to this rule because they'd have no full-time employees because none of them would have 30 hours a week or more. So they wouldn't be obligated to provide insurance or pay this tax, but they would be, in the game having to do the analysis. All right, let's move to the next slide. Once you decide to offer coverage, now to avoid, there's two types of taxes. The one is $2,000 ahead for not offering coverage. There's another tax for offering coverage that's inadequate. And to avoid the inadequate tax, your coverage has to be affordable and has to provide minimum value. Affordable means that the out-of-pocket cost to an employee for your lowest type of employee-only coverage is 9.5% of the employee's household income. So, for example, let's just take a low-end employee, somebody making $1,000 a month. Okay, 9.5% is $95. So the employee portion of employee-only coverage for that worker could not exceed $95 a month. Now, it's entirely possible that the premium for that coverage is $300 a month. And that's okay as long as the employer is picking up $205 of it and not passing any more than $95 of it to the employee, 9.5% of that employee's income, all right? If you provide coverage, but the cost is more than 9.5% of the employee's income, the risk that you run is that the employee declines that coverage, goes out to an exchange, gets coverage on an exchange, and then you would be subject to a $3,000 tax for that employee and any other employee who waives your coverage and goes to get coverage on an exchange. Now, what changes do we anticipate? You know, up until now, most employers have just charged a flat dollar. Hey, employee coverage costs X, you know, employee plus spouse Y, employee plus family Z. You know, I think rather than having flat dollar premiums for all employees, you may very well see variable premiums where everybody just says, hey, your premium, you know, the portion that you will have to pay employee will be 9.5% of whatever your rate of pay was at the beginning of the year. You know, we may see that transition. We'll have to wait and see. Another interesting point, the 9.5% threshold is based on the cost, the lowest cost of employee-only coverage, even if your employee selects another type of coverage, you know, such as family coverage. So in other words, there's no restriction on the amount that you can charge them for family coverage, and that doesn't even come into the analysis. All we care about is there an option where they could pick employee-only coverage that costs them no more than 9.5% of their pay. If you've got that type of coverage, you're good, and you don't have to worry about the tax. All right, that's it. Now, the coverage you offer has to have minimum value. What does that mean? That doesn't mean much for employers other than knowing how to pick a policy that your broker will make available to you. These policies are going to start having, you know, medallic descriptions, you know, bronze, silver, gold, platinum. A bronze plan is one that covers 60% of the cost of covered services. Silver would cover 70, gold would cover 80, and platinum would cover 90. So as employers, all you're going to have to do is say, hey, broker, is the policy that you're recommending that we purchase, does that provide at least a bronze level of coverage? The broker and the insurance company, they'll analyze the policies and they'll make sure that they provide a significant level. So this is really just a buying decision for employers to make sure they're buying good enough coverage. So there you have it. Just as a quick review, you want to make sure you're covering 95% of your employees. You want to make sure the coverage is affordable, and you want to make sure the coverage has minimum value. If you do those three things, you do not have to worry about paying any taxes under health reform. Now, this, I think, really just gives you a little bit of extra detail. The tax, of course, they didn't call it a tax. They called it an assessable payment. But interestingly, the section of the U.S. code that this rule is in is the Internal Revenue Code. So whether they call it an assessable payment or not, it's a tax, all right? It's a tax. So point B is what I mentioned. If one of your employees receives a premium tax credit or a cost-sharing reduction to pay for coverage through an exchange, there will be a way where they certify who their employer is, and you'll get a notice from the government that says, hey, one of your employees got coverage through an exchange and received the premium tax credit. If that happens, and if you haven't covered 95% of your workers, then you're going to owe the A penalty, which is the $2,000 for every one of your employees. But if you have provided coverage, but it's just for some reason it's above 9.5% for one of your workers, or it doesn't provide minimum value, then only for those employees who waive your coverage and get coverage on an exchange, for those folks, you will owe the $3,000 tax. So $2,000 tax, if it applies across the board to all of your full-time employees. The $3,000, if it applies, it only applies to the number of employees who waive your coverage and go get coverage on an exchange. Now, if your coverage is affordable and provides minimum value, go ahead and let them waive and buy an exchange. They won't be eligible for a premium tax credit or a cost sharing reduction. Therefore, it will not open you to exposure for that $3,000 tax. Final point, is it only low-income workers who will be eligible for premium tax credits if they go to the exchange? No, it is not. You look on the bottom. People who are eligible for these tax credits are people earning up to 400% of the federal poverty level. What was that last year? That was $92,000 for a family of 4. So I don't think anybody considers $92,000 a year to be low income. So what we're saying is, you know, there's a broad array of folks who will be able to go on to an exchange, get a premium tax credit. They'll be eligible to do that if your plan does not provide coverage that's affordable and provides minimum value. So you really need to focus on those 2 criteria, affordability and minimum value. All right, the main penalty, this $2,000 per year penalty, it's actually calculated on a monthly basis, which is $167 a month, and you pay $167 a month for each full-time employee above the first 30 who is not offered minimum essential coverage. Okay, so you call this the A penalty. I think we've talked about this a decent amount. The smaller penalty, the B penalty, I'm not sure how broadly it's going to apply. I think it's just going to be marginal. If an employer decides they want to play, they're going to provide coverage. They're going to do their best to make sure that they design it in a way that's affordable and that it provides minimum value. That being said, there have been some news articles even this week about large employers who have relatively low-paid workforces, folks like, you know, restaurant chains and that type of thing. They may provide bare-bones coverage enough to get them out of the $2,000 across-the-board penalty, but not enough to get them out of the $3,000 B penalty, and they're just working on the assumption that not very many of their workers will waive the slim employer coverage and go buy coverage on an exchange. That's a gamble. It may be a calculated gamble, it may be an estimate, whatever you do, but the bottom line is, if you're providing coverage and you don't meet that affordability and minimum value requirement, you're putting yourself really at the mercy of the choices made by your employees, whether they choose to go buy coverage or not. If you want to keep control in your own hands, you got to make sure your coverage is affordable and provides minimum value. All right, consequently, we hit point C. I suspect most employers are unlikely to offer coverage that's unaffordable or does not provide minimum value. But like everything else, this is a prediction. We'll see how this all plays out this year, and we'll see what next year brings. All right, the B penalty is $3,000 a year, which comes out to $250 a month, and you owe it just for each full-time employee for whom coverage is unaffordable or doesn't provide minimum value. It's capped at the A penalty amount. So, you know, for example, you have 100 employees. The maximum A penalty would be 2,000 times 70, because you get to exclude your first 30. So 2,000 times 70 would be 140,000. So if you're liable for the B penalty, just on select employees, once your B penalty reaches 140,000, it would cap. Even if you had other employees who would otherwise, you know, subject you to more B penalty, the B penalty caps out at the A penalty amount. Let's talk some examples, because I think when we put real numbers in place, it helps us understand some of these topics we've been speaking about. Let's talk about a control group. A parent with no employees has 2 subsidiaries, sub 1 and sub 2, and it owns 100% of both of them. They are a control group, parent and both sub. Parent has no employees. For each month this year, the first sub has 40 full-time employees, the second sub has 60. Because together, the control group has 100 throughout the year, they're over the 50 threshold, and therefore, the whole control group is in the game. Even the subsidiary that only has 40 employees is in the game. You know, they might think, oh, we're under 50, we don't have to worry about it. No, that's not right. They are part of a controlled group that is over 50, and therefore each subsidiary is in the game. If there was another subsidiary that had 3 employees, it would be in the game, okay? Just so you understand. You know, people get confused on this 50 number. All right, now you've got an employer who has 40 part-time workers who each average 90 hours a month. 90 hours is less than 30 a month, is less than 30 a week, so they're not full-time employees, they're part-time workers. How many hours did that group work collectively? Well, point B, you take 40 workers times 90 hours a week, or excuse me, 90 hours a month, that gives you 3,600 total part-time hours worked that month. For every month, you divide the total part-time hours worked by 120 to give you your full-time equivalents. So here, 3,600 divided by 120 is 30, and this employer has 30 full-time equivalent employees. We're continuing on with the same employer. In addition to their 30 full-time equivalents that we just calculated on the past slide, now we know that they have an average of 20 full-time employees per month. So they've got, in B, there you see they've got 20 full-time workers, 30 full-time equivalents. That equals 50. Consequently, they are likely in the game. However, we're going to run through those two exceptions that we did to see if there's any exception for them. Now, we just told you that X had 20 full-time employees. Remember, they've got 30 full-time equivalents. They've got 20 full-time employees. Well, guess what? From January to June, they had 18 full-time employees, and from July to December, they had 22. If you average that out over the course of the year, it equals 20. However, remember the 6-month periods that we looked at. During the 6-month period of January to June, the average is only 18. If you add that 18 full-timers to the 30 full-time equivalents, you're only at 48. So this employer is going to meet that 6-month exception because there's a 6-month period this year from January to June in which the average number of full-time employees plus full-time equivalents is less than 50, 48 in this example. They have a 1-year exemption. They do not have to comply with the mandate in 2014. Instead, assuming all their numbers remain constant, they will have to apply the mandate in 2015. All right, now we're talking about a new employer. Employer Z, we're going to work through this seasonal employee exception. They have 40 full-time employees throughout all of this year. So their monthly basis is 40, okay? They also had 80 seasonal full-time workers from September through December. So first step in the seasonal exception, September, October, November, December, those are 4 months. Because Z used seasonal workers during 4 or fewer months, we can continue to see if this seasonal exception is going to work for us. Now, Z has 0 full-time equivalent employees, so their average is 40 plus 0, so they're at 40. They're under 50 during all months, excluding seasonal workers. During the months that Z employed seasonal workers, September through December, the monthly average was 120, which was their 40 full-timers plus their 80 seasonals who were, each were a full-time equivalent during those 4 months. Now, the reason they exceed 50 from September through December is solely due to those 80 seasonal workers. Consequently, the seasonal worker exemption, the seasonal employee exception applies to employer Z, and they are not subject to the employer mandate. If these numbers stayed constant in future years, they would never be subject to the employer mandate. I think we have some more examples on the play or pay decision. So just real simple, that 95% coverage requirement, if you got 100 full-time employees and you offer coverage to 90 of them, that's only 90%, that's not good enough. But now we're going to provide a solution to get you to minimize the tax. All right, here we go, point A. Y would owe $2,000 for each of its 100 full-time employees because it failed the 95% standard. This would be a $200,000 tax for 2014. However, we are going to get them down to nothing. Let's go back up to slide 30. There we go. Employer reorganizes into 2 entities under common control, A and B. They move all the employees with insurance into entity A. Now entity A has 100% coverage because 90 out of the 90 employees have insurance. They've moved all of the 90 with insurance there. They've got 100% coverage, so A is going to be good. B has 10 employees. None of them are offered coverage. At a minimum now, this employer has reduced its exposure to the $2,000 per employee tax. It was going to be 2,000 times 100. Now, at most, it's going to be 2,000 times 10. So they've vastly reduced it, but we may even be able to do better than that. After the reorganization, A doesn't owe a penalty because it meets the 95% standard, and B here, with its 10 employees, is likely going to be able to avoid the penalty because you get to exclude your first 30. Remember that? And since B is under 30, we may be okay. Now, there actually have been rules that say in a controlled group setting, you've got to apportion the 30 full-time employees who you exclude. You've got to apportion that 30 among all members of the controlled group. That's sort of new guidance since this slide was prepared. So in this example, the 30 would be apportioned. Well, 90% of 30 would be 27. So there would only be 3 exclusions left for the 10 employee subsidiary. So still, you'd be bringing that down from 10 employees down to 7, and you'd only owe $2,000 on the 7, which is $14,000. So by doing some reorganization, the bottom line is they would reduce their tax liability from $200,000 to 14,000, which I think would be considered pretty good planning in most circumstances. Now, granted, it's still 14,000 of extra tax that they weren't paying before. I recognize that, but it's a heck of a lot better to pay 14 than 200,000. So we've got some extra details, just some things that I want to fill in, make sure that we've covered to hopefully help you understand things. What does this really mean? If you're a large employer over 50 that already offers group coverage and you treat your employees well, hey, good for you. That's where most of my clients fall, quite honestly. Still, you've got planning to do. And the hardest planning is going to be making sure, do you meet that 95% threshold? That's, like I say, a lot of good employers are out there that may only provide coverage to 85 or 90% of their workers. They're still considered good large employers, but you've really got to measure it now and make sure you meet that 95% threshold. Also, how do you meet that 95% threshold? You've got to know the number of full-time employees that you have. And for a lot of employers, that's going to be some work. You may have all kinds of contingent workers, contract workers. We always know there's been a dispute about whether somebody's a contract worker or an employee. Well, now, the risk has just been ratcheted up one extra level. Because if you've got somebody you classify as an independent contractor and it turns out that they were an employee, well, they count in determining whether or not you cover 95% of your employees. And if you don't, you owe $2,000 tax for all your employees. So you really need to pay a lot of attention to this ahead of time. Because if you're after the fact, there's nothing you can do to change it. The IRS comes in and says, oh, you had 1,000 workers and you didn't meet the 95% threshold. Okay, what's that? 2,000 times 1,000? 2,000 is 2 million. Please give us $2 million in tax. End of discussion, okay? It's critical to have good data and to plan in advance to avoid this tax. That's what this really means for large employers. Now, when you're determining, some people we know they're full-time. You're hired as a full-time worker. You are a full-time employee. You get full-time benefits. Everything's good. But in this day and age, there are many, contingent workers, they might be called, part-time workers. Under health reform regs, they call them variable hour employees, people who you don't know at the beginning of the year whether they're going to be full-time or not. Those folks, here's what you do. You have a measurement period. During the measurement period, you measure their actual hours worked, and if it rises to the full-time employee threshold, then during the following stability period, they are treated as a full-time employee. So, for example, we say here measurement periods can be 3 to 12 months. Most employers I'm working with are going with the 12 months, and they're saying, okay, my measurement period is 2013. So I've got a part-time worker. During 2013, they work 1,600 hours. Well, that's full-time because 30 hours a week times 52 weeks is 1,560 hours. So anything 1,560 and above means full-time for health reform purposes. So, okay, during 2013, because they worked 1,560 or more hours, they are now deemed to be full-time employees for the following stability period, which will be 2014. So if in 2014 they only work 500 hours, who cares? They are deemed to be full-time employees during all of 2014 because they were full-time during the 2013 measurement period. So it's just basically, and then of course 2014 will be the stability period for 2013, but it will also be the measurement period for 2015. So in that example where they only worked 500 hours in 2014, yeah, they would be treated full-time during 2014 due to their working hours in 2013, but during 2015 they would be back to part-time again. They would not be a full-time employee because during the measurement period of 2014 they only worked 500 hours. So really it's just a 1-year delay based on your prior hours worked. That's how you're going to measure the full-time status of these variable hour workers. Now, of course, you're allowed to put in an administrative period up to 90 days during which you get folks enrolled. That's just basically like your waiting period for your normal full-time employees. There's another transition. All of this is written on the assumption that the employer mandate begins January 1, 2014, and it generally does. However, if you already have a health plan in place and your health plan operates on a fiscal year rather than the 2014 calendar year, then you can begin determining your penalties on the first day of your 2014 fiscal plan year. Say you're on a May 1st plan year, okay? January, February, March, April. That's 4 months of potential penalties. You won't have to worry about it. You can begin your analysis on May 1, 2014. In order to be able to do this, your plan had to be in place as of December of last year, December 27, 2012, and you must have kept your eligibility terms in place as they were back in December of 2012. So a little bit of a transition for those of you who have fiscal year health plan years. On to our to-do list. What are we going to do from now until the end of the year? Well, number one on the list, determine whether your business is an applicable large employer. Are you above 50 or over 50? For some of you, it'll be very easy. For some of you, it may be a little more complex. If you're one of the folks who have some complexity here and have some work to do, I would encourage you to engage an advisor, a lawyer, an accountant, a well-informed insurance broker. There's some brokers who know a lot. There's some brokers who aren't really up to speed on this. You got to make sure, as Lapriel is, you got to make sure if you're with Lapriel, you're in good shape. So I don't need to worry about belabor this point. It's a good thing about being with somebody who knows what they're doing. But you need to have somebody help you to make sure you've gone through it right, to make sure you're over the 50. All right? Point number two, of course, you've got to have a thorough accounting of all your full-time employees. You've got to review all of your worker classifications and make sure you've got people classified properly, and look at your seasonal workers. There's a lot of analysis to do here. Point three, maintain documentation of this analysis, because I guarantee you there's going to be tax forms that the IRS is going to release. Even if you're providing insurance and you don't have to pay any tax, you're going to have to show why you're covering enough people and or why you're not a large employer. So there will be tax returns that we all have to return to prove that we're satisfying our obligation or that we're not subject to this employer mandate. All right? Moving on to the next slide, item 4 on the to-do list. After we have determined our large employer status and documented that well, really coming up to June 1st deadline quite soon, you next need to decide, hey, does that 2013 transition exception potentially apply to us? That's the one where we can find 6 months during 2013, 6 months in a row during 2013, when we have fewer than 50 employees. Even if our average for all of 2015 for all of 2013 is going to be over 50, if we can find a 6-month period where we're under 50, we're golden, and we get a 1-year delay. So you're going to need to look at that. And the first month that you can look at that is really at the end of June, because then you have January through June numbers. You can look at where you are, and you may be able to tweak your numbers in July and later months to get a 6-month period where your average is under 50. So you've got some planning ability there to give yourself a 1-year delay. All right, then after you look at that and begin planning for that, you're going to go to step 5 here. You really want to look and say, okay, what's our total number of full-time employees, and do we offer coverage to 95% of them? If not, you're going to have to say, well, can we expand an offer of coverage? If we're at 90%, is there 5%, another 5% chunk of our workforce we can offer coverage to? Now, keep in mind, all you have to do is offer coverage. If you offer and they don't take it, hey, you're golden, all right? Of course, what do you have to offer them? You've got to offer them coverage that's affordable and provides minimum value if you want to eliminate all risk of tax penalties. By September 1, this may be a little early, but if I was an employer, that's what I'd be pushing my broker for. You really want to know what your potential premium structure is going to be for the following year, 2014. Because when you, the employer, know the true insurance premiums, then you can start designing which portion of the premiums employees will have to pay. You know, for example, suppose you've got a workforce where the vast majority of your people select family coverage. Great, that's fine. You don't have to worry about that. But you are going to have to make sure that your employee premium for employee-only coverage would be kept under 9.5% of income, even if nobody takes it. This is a plan design thing, so you've got to, again, plan to avoid this tax. All right. Also, by that time, step 7, you're going to want to make sure that your current plan offers a bronze level of value. If not, you're going to say, hey, broker, hey, Lapriel, give us some quotes for bronze coverage for next year, because we might have to up our coverage level, okay? And these dates are all dates that I've kind of put in for planning purposes to help you out. They are not hard and fast deadlines imposed by the IRS. I'm just trying to give people a working schedule, a calendar, so that they know that they're progressing appropriately and making the decisions and doing the analysis they need to do to not be slammed next year by this tax. Okay, so by September 15th, determine whether you're going to have to expand your coverage to extra employees to avoid penalties. And then, of course, what's the analysis there? Well, you compare the cost of expanding coverage to the cost of paying a tax. And, the cost of expanded coverage has 2 parts. One, the cost of actually paying the employer portion of the premium. That's step one. But step two is how many people are really going to elect that coverage. Say we've got 30 office workers and 970 field workers, and right now we only cover the office workers. Well, maybe and all of the field workers happen to reach full-time status, okay? Maybe we offer coverage to all 970 of them, and the cost of that, if they all elected it, would be huge. But as a practical matter, only a handful are going to elect coverage. Okay, we've got to do those estimates, and we've got to compare the cost of that handful who elect coverage to the cost of paying the tax. Only after you go through that comparison will you know which is the best, from a cost perspective, the best approach to take. All right, by October 1st, there's going to be a notice that you have to give to your employees regarding these public exchanges. The notice was just released last week. You've got to give it out by October 1st, and it says, hey, employees, there's these new exchanges starting next year in 2014. If you want, you can waive our coverage and go buy coverage on an exchange. But, oh, by the way, we're offering you affordable coverage that offers minimum value, so consequently, if you do waive our coverage and go to an exchange, you will not be able to get a premium tax credit or any other premium assistance, and you will lose the employer portion of the insurance premium that we pay if you take our insurance. So there's a notice, it's a form notice, you've got to get that out by October 1st. That October 1st is a hard and fast real deadline, by the way. November 1st, this is a hard and fast deadline too. You've got to distribute the new summary of benefits and coverage. This really applies to everybody. It's a new document. If you should have seen it this year for this plan. It's kind of like, it looks blue and white striped. It's formatted by the Department of Labor. It's provided, and it discusses your out-of-pockets on your insurance and it walks through a couple of cost examples for, I think, having a baby and maybe having diabetes, two conditions that I suppose are somewhat common. So the new summary of benefits and coverage for 2014, the statutory deadline is 60 days before the beginning of the plan year. So that document has to be distributed by November 1st. Of course, if there's no material changes, then the one from last year is fine, but I suspect most plans are going to have some material changes with respect to premiums or items covered or that type of thing. By December 1st, you're going to have open enrollment for 2014, and then next year in January, you're going to say, hey, let's look at these new IRS compliance reporting requirements, because we know there's going to be new tax forms, and all of this data that we've been analyzing from now until next January, we're going to be able to, and we're going to be obligated to put that information on a tax return and give it to the IRS to show them we're complying with this new mandate. Thank you for bearing with me through all this. I know it's complex. I've tried to keep it simple and straightforward as possible. I hope that I've been understandable. Thank you for spending an hour with us. Thanks to Lapreel and Benefit Partners Unlimited for putting this event on. We appreciate it. We're glad that we're all working on learning this rule and learning how to comply with it. Thanks, and have a great rest of the day. I'm going to sign off now. Bye-bye.
Thanks, George, and thanks to all of you for your attendance today. I will contact each of you to discuss your questions and the changes that we're going to need to make.